It's nice to actually make money in the stock market for once. I always lose, man. I'm such a loser when it comes to stocks. I never should. I should always just stay VTI and be done with it. Let's see. Low interest rates and muted growth actually work real well for non-mortgage REITs. Non-mortgage REITs. What about junk bonds? I think we did talk about junk bonds. I wouldn't touch the 10-foot pole, man. Why take the risk on junk bonds, which have close to the volatility of stocks, but there's no upside? You're getting what, 3.5? Just buy the stock. Buy the stock. What's up, Brady? BLM versus MAGA odds. Okay. I thought you were asking about a stock, man. Are you on Clay Travis's website there, Handyman? So Handyman is pushing DraftKings or FanDuel, because every time I listen to Clay Travis, he goes, "You go to hey, look everybody, you all come here, whoa, come here. Come here. All right. You guys haven't seen him for a while. Can you say hey? They just got back from a walk, it looks like. Remember that? Hey! Oh, jeez, please. Ouch. Remember Finn and that's your Diet Coke? All right, come here, Pablo. And here's Pablo. Oh, hey. I love you. Hi, Finny. You want to see him? Hi. What's up, big boy? Yeah, he's a good boy. Yeah, I love you guys. Love you. Want to go play? Want to go play? All right, there you guys go. Go play, play. Wait, hey, place, Pablo, place. Thing, place. Good boys. Place. No, place. You saw that, didn't you? So Finny's like a puppy. He's like 8,000 pounds, well, compared to Pablo. And Pablo's like an old man now. Pablo's like, get off my yard. And Finny's like, oh my goodness, man. And Finny just loves, he's like, Pablo, play. And Pablo's like, dude, I'm trying to chill. Get out of my space. And Finny's like, no, play. And after like 25 minutes of doing that, Pablo finally goes, Rah! And feels, oh. So, oh my goodness, this is the funniest thing in the world. Oh. All right. So, any difference between Roth and traditional? Let's see here. 6 to 7% under the Great Reset. Okay. Favorite Vanguard for Roth, please. Talked about that. I'm 30. So my man, Unhandyman, is 33% of his Roth. On his Roth is here. Anyone else thinking XOM over VTI? XOM over VTI. What? That's you're gonna make that. I mean, what? You don't see an odd comparison there. Whew. Let's see. There's a stock rotation. Cute says there's a stock rotation going on. International stocks. Are international stocks moving the ball there? I haven't paid any attention. Small cap value and energy stocks are winning the past 2 to 3 months. Really? Energy stocks with freaking Steely Joe coming in? Oh, man. I just posted some stuff. I don't know if I posted on YouTube. I did post it on my MeWe account. And if you're not on MeWe, you should be, because Facebook sucks. But anyway, talk about the Japanese energy crisis and whatnot. And it's only going to get worse, dude. In fact, my man there, Hemet Sunshine in California, hope you don't need any electricity anytime soon, because they're shutting everything down, man. And no nuclear, no hydro, no dirty coal, no natural gas. So if you're needing some electricity, and then they're going to mandate EVs, the whole thing is just, we are living in fantasy land run by the left. It's going to be fun. It's going to be fun. But anyway, this small cap value. I don't know that. That's good. That's good. I like to see the rotation. And remember, there is something called momentum. I mean, momentum is a trade. I don't trade. I actually buy. But at the end of the day, usually you want to cut your losers and ride your winners. And if small cap is taking off, well, you might want to get more in there. Obviously just buy the VTI or buy Or if you want to go heavy, take some profits off the growth side of your portfolio and put it into the value side. That makes sense. And we've had 5 years of significant growth dominance over value. I'm just telling you, man. And then the late night, I'll say this till I'm blue in the face. Is it 95 to 2000? Value got smoked by growth. All right. No one wanted value. No one wanted dividends. That was old fogey, good time rock and roll. I read the other day about James Glassman saying the metrics are old. No one uses price earnings ratios, dividend yields anymore. And then lo and behold, kaboom, kabing, kabunk. After that, the dividends saved the day for stockholders. That's all there is to it. The teens, exact opposite. It just goes like that. Unfortunately, it's completely random. We don't know when the cycle is going to change, but it seems like there's some opportunity there right now. All right. If global inflation is always let's take a look at that article I saw on inflation. That was kind of concerning there. So we're going to go to F Trust Portfolios. And you know me, I'm a big fan of, I tried to be, all right, hold on a second. I got this Rush song in my head, the Necromancer that I shared you guys today. All right. Oh, the old Rush, dude. Good almighty. All right. Moody's reported that its global speculative grade default rate stood at 6.6 in December, puts the average default rate of 4.2. Its baseline scenario sees the default rate peaking at 7.5% in March before dropping to 4.7 by December 2021. Moody's recorded 209 defaults in 2020, nearly double the defaults in 2019. The U.S. speculative grade default rate stood at 8.4% in December. Sees it going about 9.1. All right, so basically, Moody's looks like the default rate on global speculative grade. I'm presuming that's junk bonds is significantly higher and will be higher throughout 2021. So there you go. Don't buy junk bonds. If you got them, I don't know I literally have no idea what junk bonds did last year. I don't think it's worth owning. All right, so we're gonna go to commentaries right here. We want to talk about inflation. They stand to feed right there. That is of interest to me. That's 40.4%. The CPI in December. That's pretty significant. That's a pretty significant jump. Consumer prices continue to trend higher. That started back in June and ended 2020 with prices up 1.4%. So we had consumer prices up of 1.4, which is not high. But while the declines of March through May held down the full year price changes, movement from May has been pronounced up at 4.1. So the significant first quarter into the latter part of the second quarter knocked everything down significantly. Since then, it's been pretty significant on the upside. So 4.1 on the up after being down for basically the first part of the year. In other words, inflation since the early shutdown months have been running well above the Federal Reserve inflation rate of 2. This stands in stark contrast to the annualized decline of 2.4 earlier this year. All right. However, don't expect this to change the Fed's plan to keep short-term rates near zero for the foreseeable future. It will take months for years ago comparisons to reach and then exceed the 2% target, and even longer before the labor market has healed to the point the Fed begins to seriously move higher. Still, the recent burst of inflation hints at the impact of massive 24.4% increase in the money supply of M2 as supply chains continue to recover. The typically volatile food and energy sectors played a significant role in December as energy prices rose 4%, led by an 8.4% jump in the gasoline. I'd rather prefer to strip out that because that's so volatile. But so if we do strip it out, the core prices rose a more modest 0.1%. That's not that big a deal. So if you don't take, so basically gasoline is what caused that increase in inflation right there. Gasoline. So I don't know. Is that a one-time thing? Well, let's see. However, underlying fundamentals point to a higher risk of rising inflation than after the 2008 recession. The coronavirus response to the pandemic is the first recession on record where personal income has increased due to government stimulus checks and boosted unemployment insurance that replaced more than 100% of lost wages. Meanwhile, measures like let's read this. All right. So he's saying this is the first time in history of the recession we've actually had an increase in personal income. Why? Because of government stimulus check and boosted unemployment insurance replaced more than 100% of lost wages for many workers. Well, first of all, that's UBI, right, 100% UBI. Second of all, that can't keep going on. So if the cause of inflation is because we never went down because of stimulus checks and unemployment insurance, that's not a long-term inflationary. That's fake. That's literally fake. You can print it only so long before you just can't. You can use MMT. We're using MMT right now. Even the MMT advocates, Stephanie Kelton and Mosher, I think is his name, even they say you can't keep using MMT. At some point, you are going to have inflation. So anyway, I wonder if the Democrats, now that they're going to be in charge, I wonder if they're going to try to have unemployment benefits for forever, like they typically want to do. It'll be interesting to see, because it's easy to blame Bush or Trump. They don't care about the employment of unemployment, but once they're in charge, they're going to have to come to the conclusion that at some point you got to make people go back to work, man. You can't pay people to sit at home. At least you can't pay people 100% of what they were making when they were working. That's not good. All right. The mismatch between supply and demand will eventually mean too many dollars chasing too few goods. I'm actually surprised to hear him saying that. It's not a permanent. You're not permanently getting that 100% lost wages. I don't get why that's weird to me. Additional stimulus spending as the Democrats secure control of the Senate. That said, it's clear the economic recovery is on the way. The worst economic quarter since the post-World War II is behind us. And the question is, how quickly can we get back to normal? I'm still stunned that Trump did not see this, and it cost him his election, man. It cost him the election. Regardless of what you want to say about the vote, at the end of the day, he by allowing the panic of coronavirus, it allowed the mail-in ballots, which allowed it to be however you want to say, right or wrong, I don't care. But if we did not have the massive amount of mail-in ballots, Trump would have got reelected with a landslide. It's just a fact. You could say, well, he still got reelected in a landslide. Well, he didn't, because he's not going to be in office. And he allowed what happened to happen because of his scare and listen to Fauci. And I tell you, man, you got to blame Trump or Pence. You got to blame them both for listening to these clowns and not seeing that Fauci was a freaking Democratic lackey going back to Hillary Clinton days. I did an article, the political Anthony Fauci. I read an article back in February. People hated me on that because they all loved him. I said, Fauci is a Hillary ass kisser. And here is the evidence of that. And everyone's like, oh, no. And I was like, dude, well, how does Trump not see this? I said it back then. The most frustrating thing in I tell you, man, for all the accolades Trump gets as being a negotiator and all that, and how did you fall for this? Could you not see that a closing of the economy, and on top of that, a massive amount of mail-in ballots, which were not going to be checked for signatures, which is what happened here in Georgia? How could you not see that? It's crazy. All right, let's see. The dotted line is the probability of a normal year. Okay, we're still talking about Vanguard stuff. Yep. If you're accumulating, I don't know how you have bonds if you're still accumulating. I just don't know, man. No, it's annual. So adrenaline junkie 0.75 over 10 years is annualized. It's annualized. So it's going to be 0.75 each and every year. Anyone accidentally max out the Roth by February? Yeah, sweet, man. After 2020, you should be expecting, interesting. What's your take on that, Vinyl? What would be, all right, high inflation, higher interest rates would be a relatively low grade of surprise. Yeah, I don't think we're not having higher interest rates anytime soon. I mean, we might have higher interest rates because the market demands it. I don't think not the Fed's not going to demand it. No way. But anyway, that's come on, that's weak sauce. You said there should be surprise of some sort. Well, your surprise got to be more than inflation and higher interest rates. Give us something to chomp on, man. Something. I'd be surprised if I'm not surprised what happens 20. So remember, somebody had posted this meme. 2020 was bad, but now he's legal, so 2021 is going to be worse or something like that. Or now that 2021 is legal to drink, this is going to be crazy or something like that. I thought that's kind of funny, because we went from 20 to 21. It's going to be bad. Now we got the bottles of Jim and freaking Jack and freaking Sierra Nevada and pints of Guinness. Woo wee! Some black and tans with Bass and Bass on the bottom and Guinness on top. All right, so let's hear what you think. If you guys have thoughts, what would be the surprise in 2021? I think so. Just curious what your thoughts are. I think that are they still going to go after Trump when he's out of office? I hope they do. And the reason I hope they do is because that is going to waste a lot of momentum that can't be used to put more socialism on us. And Trump has the chutzpah. Is it chutzpah? Whatever the hell it is. He's got the balls essentially, and he's got the money to fight back with lawyers that hopefully he will defend him. Unlike the parlor lawyers, or unlike the Trump lawyers in Pennsylvania, freaking scumbags. But he'll be able to pay enough money to lawyers to defend him. I hope they waste a lot of energy on going after Trump. I really, really do. And it'll get the rest of the MAGA people fired up. We have 10 Republicans today who voted to impeach Liz Cheney. I was stunned. I'm not stunned anymore. I was when I first heard that she was a never Trumper, I was like, Liz Cheney. I always kind of liked her, but she can kiss my big fat behind. Kinzinger from Illinois, he's always a scumbag. The guy who took Justin Amash's seat up in Michigan, and then Fred Upton. I was like, Fred Upton's still around? How did that? And that guy, clown central, man. Anyway, so 10 of the 210 GOP people we have voted to impeach Trump. I couldn't believe it. Democrats never do that, man. It's nuts. I'm still surprised that not one GOP voted for Obamacare or the Clinton tax increases of 1993. Not one Republican voted for that. Or Obamacare. I was still stunned by that, to be honest with you. So I'm not sure what Liz Cheney is trying to do by be on the impeachment Trump side. That doesn't make any sense to me. I mean, I know at the end of the day they're trying to draw a line between the never Trumpers and the regular MAGA people. It's weird to me because never Trumpers are nothing. Did you hear what's going on with the Lincoln Project? The founder, John Weaver. Do yourself a favor, do some research on the controversy surrounding John Weaver. And it won't surprise you when you know who Rick Wilson is. These guys are just freaking sick people. Politics is run by just some real slime balls. James Carville for the Democrats, Rick Wilson for the Republicans, John Weaver. These guys are just real ugly slime balls, man. And they get into politics because that's their only way they can get power. And they get it and they want to yield it. And for some reason, people give them money. It's weird. I just find that strange. All right, my man's got 60% in the bond. Is that BTLX? Is that the long-term bond index? I wouldn't have any bonds in my Roth. I'll tell you that right now. All right, if they can can't say that, Jake. They can't say that. I bought tons of value and COVID tanked the market. Okay. At least dividends still coming in. That's what I love about dividends. At least they're still coming in, man. Right on. I'm looking for a good 6% dividend yield. They're hard to find. Yep. I'm selling everything and putting into Bitcoin. Does Vanguard VTSAX and a Roth? Yeah, absolutely. Yep. Locking money in bonds. If you invest in bond mutual fund, can't you purchase and sell? Okay, so Wilma says, all right, so that's a good question. Let's go over how this works. Locking money in bonds. If it's a mutual fund, can't you purchase and sell at any time? Absolutely you can. All right, so the question is, so let's just, I just want to reiterate again how bonds work, because just because you're in a mutual fund doesn't exclude you from this at all. All right, so we got a bond is issued at 1,000 and it matures at 1,000. Right, every single bond is like this. Now, at some point, I think they need to do bonds in perpetuity for the United States. They say we're going to issue 50 or 100-year bonds, or just bonds forever that never mature, and we'll pay you 2% a year. All right, so that's how it works. So you get a par value at 1,000, which is the issue date right here, and then you get a mature value at 1,000 or par value. All right, and we're just going to use a 2% coupon. All right, 2% coupon. So that means you're getting $20 every single year on this bond, and we'll just say it's a 5-year bond for simplicity. 1, 2, 3, 4, 5. All right, so every single year you're getting $20. You got a 2% coupon. Every single year you're getting $20. So this is a 5-year bond. So there's only 2 things that can happen to this bond. 2 things, and 2 things only. The bond can either go bankrupt or the bond could mature. That's it. It can't do anything else. A bond is like a CD. It's really like a CD. That's it. It can either go bankrupt, which you lose everything other than whatever the coupon payments you got, or it can mature and you get the par value. So you loaned the company 1,000. That's your loan amount, 1,000, and then after 5 years you get back 1,000. That's how it works. Literally, so you're getting your money back. In the interim, the bank or the company or the government is giving you $20 a year as a reward for you loaning them their money. That's it. So there's only 2 other things that can happen. They could go bankrupt, in which you get 0 back, or it could mature at par, which is 1,000. It will never mature above par. It will never mature above par. So now what happens is, on occasion, a 5-year bond is not that long, so you won't have a lot of volatility. But on a bond that has a 2% coupon, all right, if another bond, so let's say now we're in year 1 of this bond. So now we just cleared 1-year bond, so we only have 4 years of coupons left. That's it. But now I can buy another bond. The interest rates go to 1%. All right. Oops. Oh boy. What's up, gangsta? So now we got the 2% bond, and I got 4 years left. 1, 2, 3, 4, 2, 20, 20, 20, 20. All right, so now I got a 1% bond, but I got 5 years at 1%. 10, 10, 10, 10, 10. All right, so now we got another. So again, I'm 1 year into this bond. Now that same company, because interest rates have gone down, have issued me a 1% bond now. All right. So now I'm getting $10 a year on that 1% interest. But I have 5 years now. I only got 4 years here. I got 5 years here for it to mature. So if you were, let's just say you got a raise of $50,000 for simplicity, which bond would cost more? Which bond is more valuable to you? All right. Well, if everything is even, the credit rating agencies, the company, and all that is the same, this bond is going to be more expensive because you're getting double the yield. You're getting $20 instead of 10, and you only have 4 years before it matures. All right. So you're going to say both bonds were issued at $1,000 as the issue, the par value. Both bonds mature at $1,000, but both bonds aren't going to trade at 1,000. Because this bond inherently is more expensive than this bond because I get double the interest and I only have 4 years of maturity. So I have 1 less year of risk for the company to go bankrupt. So I'm willing to pay, and there's numbers you can do to see the exact price this bond would be. But let's just say I'm going to pay $1,100 for this bond. All right. So I'm saying, look, man, I'm not going to pay $1,000 if I'm paying $1,000 for this bond, well, no one's going to sell this to me for $1,000. They're going to sell it to me for $1,100. All right. But what does it mature at? What does it mature at? It still matures at $1,000. It still matures at $1,000. So it inherently is going to lose $100 of cost because it will mature at $1,000. And people think mutual funds, because they are liquid, don't follow the same premise. Mutual funds still buy and sell bonds just like that. It doesn't change the facts that bonds have a certain level of return that you cannot. It has to be that. It's mathematical. The only way it can't give you that return is if it goes bankrupt. Now, going back to the bonds were up 9% last year, whatever the hell they were. Okay, that's fine. So now we still have $1,000 bond. Let's just say it's up 9%. So now it's at $1,090. All right. So the bond was up. Is that 9%? Yeah, right. $1,090. The bond now is selling for $1,090. It's still going to mature at $1,000. It's still going to mature. Someone is going to buy this bond at $190, and they're going to get it back at $1,000. That's inevitable for that to happen. So the question that comes to mind is, if Wilma is going to say, "Look, man, I want to sell my bonds," well, you're selling them at a premium, which is fine. But then, what are you going to reinvest in it? You're going to reinvest it in other bonds? Well, then you just defeat the purpose. I mean, you're going to invest them in other bonds that are paying a lower interest rate. So that doesn't make sense. Might as well just keep the bond you already have, unless credit ratings change or something like that. Or you invest in stocks, or you invest in, you pay off debt, one of those things. But you cannot escape from the fact that bonds is like clockwork, man. Buy it at $1,000, it matures at $1,000. Sometimes it'll go up in price. It will always go back down. There's no getting around it. Somebody is going to lose that $90 capital appreciation. It'll come back to $1,000. It's just all there is to it. Now, as such, it's fine that you got a 9% gain, but to turn around and reinvest in other bonds is silly, because you're still in the same situation. Now, what you could do is say, look, man, value stocks are underappreciated. Bonds have done a whole lot better than I thought they would, but that's a fleeting return. So let me sell some of my bonds and move it to value stocks. You can make that argument, but then I'd wonder why you're in bonds to begin with. Were you in bonds to begin with because you thought the market was going to tank? Has that changed? I don't think it has. Not after last year's return. My goodness. And we still have a pretty hurting economy. So that'd be up for someone to say, I think bond market, I take my gains from the bonds and turn around and invest in stocks. I got no qualm with that, as long as someone knows what they're doing. That's the method of what they're trying to accomplish. If they're just saying my bonds are up 9% and I expect that to continue, that's just foolhardy. So mutual funds have to, ETFs, they all have to do the same thing. Pension plans, insurance companies. The biggest bond holders are, other than other governments, are pension plans and insurance companies. Insurance companies, by and large, insurance companies, they have to maintain a certain rating for the insurance company, in which to make sure that the insured. I'm a member of USAA. I have life insurance through USAA. If I die, I have to make sure that I know that my wife is going to get paid. You see what I'm saying? So I'm not going to buy a fly-by-night insurance company to insure my life if they're investing in risky crap. They've got to have some stability in their portfolio. So insurance companies are going to be pretty conservative. They own a lot of bonds and a lot of safe bonds, because they got to make sure that they have enough money in which to pay their claimants or their insureds, if that makes sense. So pensions do the same thing. In fact, one of the problems that we had in 2008 was a lot of pensions and insurance companies and endowments, as credit rating agencies dropped the bond rates, and as prices fell to lack of liquidity and stuff, they could not, by charter, they could not own the bonds. And again, that's attributed to mark-to-market accounting, which I won't go into here, but they had to liquidate. They had to, by law, by their charter, not by law. They had to liquidate their bonds because by the rules of their charter said, if a bond drops from A to triple B, can't own it. Now you have all of these companies in the same exact boat, and they all have to sell. Flood in the market out there. They got to sell. When you have that many sellers and there's no buyers, because don't forget, the biggest owners of bonds are insurance companies and pension companies, other than governments. Well, these are also the both sides of the trades. For by and large, the bond buyers, the bond traders are the same people. So now they're all flooding the market with the sell side. There's no one on the other side. No one on the other side. So the price is dropping because they get all these people. The more the price drops, the more the bonds lost their credit agents or ratings, which meant the more they had to flood the market. It was insane. All because of government policies. Yay for government. There to rescue us. Yeah, the point being is bonds are, I don't like bonds. I'm telling you right now, I think bonds are silly. You shouldn't own them by and large. There are reasons to own them. I like Ginnie Mae. But generally speaking, in this low interest rate environment, you know, I was just be in cash, man. You know what I'm saying? A high yield savings account, share certificate account at the local credit union. Bonds don't do that much for you right now. They just don't. Now, with that said, I said that last year, and I got egg on my face because bonds were up 9% or whatever the hell they were. Okay, I'm just telling you right now, it doesn't take a rocket science to see what happened to. I don't think the BND. I'm not sure what happened to BND, but let's look at. Wait, hold a sec. Yeah, right. There's BND right there, and so you can see the price of the bond market index fell from 88. And what's that? 88.49 in December to 87, and so it basically fell $2, not much, but $2 in the last 3 months, and that's BND, which has some corporate bonds in there too. And if we just look at the 30-year Treasury, yeah. So if this is a 30-year, let's just the 3 month. That's a yield on the 30-year Treasury. The yield on the 30-year Treasury. You see a jump like that, that means the bonds work as a seesaw, so the price has dropped. The corresponding to the yield going up. It's been tough out there for sure. All right, let's see what else we got here. Yeah, Ginnie Mae. I love Ginnie Mae. Ginnie Mae is 3 to 5 years. You know, I still say have some cash. You know, you want some cash with the bank, Charles, but Ginnie Mae, I'm a huge fan, man. Huge fan.